Hello and welcome to this special episode of Prinsights Global Spotlight. I am so thrilled today to be joined by the CEO of Money Metals Exchange, Stefan Gleason, who has been at this position since 2010, has seen so much, and is involved in so much more that is important for everybody to know about at this time in the metals space. Stefan, thank you so much for clearing
Yeah,
some space to be with us here today.
yeah, of course. It's great to be on your show, and we appreciate you doing the Money Metals podcast from time to time as well.
Yes, thank you. I mean, I think it's so important to continue communication about so many changes that are happening
Yeah.
as we sit here and speak. So on that, gold, silver in particular, maybe we can start with that, and maybe before that, even a little bit about your background and how you came to to being the founder, to creating this
Mm.
incredible platform.
Yeah, well, I was in public policy for 15 years in Washington, D.C., and I was working on causes promoting limited government and individual liberty and so forth. And I started looking at the Federal Reserve System basically, and I was a real estate investor. I was looking at what moves interest rates, and I started pulling the thread, and it was just remarkable, the system that we have and how nobody really realizes what a complete like house of cards it is, and what is money and what is credit and all that. And just learning about that kind of drove me into hard money, into investing in gold and silver as a way of diversifying out of this paper money system. And then I left public policy to form Money Metals in 2010 with my brother and my brother-in-law. There was an interim period where I was involved in publishing, financial newsletter publishing. I had a large subscription base. And the reason we launched Money Metals was because the advertisers who were promoting gold and silver as investments, the ones who wanted to get space in our financial newsletter, were promoting the wrong thing. They were promoting so-called rare coins and collectibles and commemorative items that are really not worth the metal content. I should say they're only worth the metal content and not whatever like subjective value in most cases. And these things are being pushed as these great investments. And we didn't want to put that in front of our subscribers. What we really thought people should be investing in if they wanted exposure to gold and silver was the same thing we as individuals were, which was bullion coins and bars and rounds, things that are priced based on the metal value, the metal content, the melt value that's globally transparent in the marketplace. And those are very small margin items for the seller, which is why a lot of people promote the high margin stuff. So we just decided we would offer it as an in-house service to our subscribers, and that's how we launched Money Metals. And grew. It's been 15 years. About 5 years in, after kind of building the business up, we also went back and I looked back at the public policy side of things and thought, there's a lot of opportunity here to help on the sound money front. And so we launched a project within Money Metals to promote sound money public policy at the federal and particularly at the state level. And so that's been another, I guess, passion of ours, is to not just help investors get into the right thing, educate them on why to own gold and silver, but then also to promote the values that we have, which is what's driven us to wanting to protect ourselves in gold and silver, and that is, sound money.
And actually, it's interesting, but there have been a number of states. You talk about also
Yeah.
operating at the state level that have really adopted those principles, especially recently.
Yeah, and there's in our view, for gold to resume its role as money, we have to remove, first of all, the friction around the buying and the selling, and the primary friction is taxes. So at the state level, there used to be sales taxes in most states on gold and silver purchases. As of today, there's only 5 states that remain that fully tax purchases of gold and silver. We've also gone after income tax at the state level. Now 13 states exempt gold and silver from the income tax. And then we're promoting things like having a state hold gold as a reserve asset, hold it in their pension plan, reduce regulation and intrusions on dealers and individual investors when they want to avail themselves of gold and silver. So we have a very active project around the country. We passed about 30 bills in the last 10 years. And that's definitely an area of growth that we're seeing where there's a lot more sort of momentum developing. And Some of that, of course, is being caused by the bad things that are happening, the with the currency and with the economy and so forth. But a lot of it is also just the momentum of getting some successes, and then other states are like, hey. So I mean, the bottom line is it's a federal problem. The problem begins with the federal government, with the Federal Reserve System, the U.S. Treasury, really all central banks. But there are some things that states can do. They don't have to be sitting ducks. They can take certain steps, and so we've been encouraging states to do that.
No, that's fantastic, and yeah, the momentum that you're having, and hopefully will continue to accelerate is also at this point matching the moment, which is changing very rapidly in terms of more investors, more states, more pension funds coming into gold and silver as commodity allocations that are worth their actual weight relative to fiat money and relative to a lot of the problems we continue to see in the banking system. For example, just recently, the regional bank loan problems that have resurfaced that continue to be bubbling beneath the surface, and gold, silver. There are ways that to protect people, and the fact that you're providing that access, that research, and that push on the state and federal level is very, very important for so many. And I just want to personally thank you for what
Thank
you do. So let's go on and talk about both of those, but let's talk about silver, because there has been so much movement in the silver space, and that sheer gap between what is available above the ground and what is demanded, and the growing demand for silver, and how you see that the problems, the squeezes that we see happening in silver, and what that will do to the price and the investment path for people.
Yeah. Well, by certain accounts, there is still a very large amount of silver above ground. Maybe several billion ounces, maybe even more than there is gold. Actually, that's an interesting fact. There's only about 6 billion ounces of gold available, really, that have ever been mined. And most of that is still available above ground because it's hoarded and put into banks and private hoards and so forth. In the case of silver, there's been way more silver mined, but a lot of it most of it has gone away, and it's been consumed and has not been saved. And so the above ground supplies are not necessarily more than even the ounces of gold. So I would say that, silver is about as rare as gold in terms of the above ground supplies. In terms of readily available silver, though, we're only talking about 1 to 2 billion, maybe about 2 billion ounces. But there's significant stresses developing in the marketplace right now that we're seeing. In fact, in the last 3 weeks, there's been a lot of news on this, but we've been directly involved in some of it. There is actually a very significant shortage developing on the London market, which is the largest silver market, and that's where basically the clearing of the price happens for all silver transactions around the globe, happens in the London market. And there's lots of refineries around London. There's a fair amount of supply there, but there's also way more, I should say, claims on silver than there is actual silver. Because what ends up happening is, if you have silver that you're owed, you have silver credits on the London market, and the banks will take that and lend it out to others. And so they create this massive Christmas tree of leverage and rehypothecation on the physical silver that's in the vaults. And so it's just like a bank, where it's assumed that most of the time, most people are not going to want to pull their cash out, or in this case, their silver out. And so you can get away with very large amounts of leverage with a relatively small amount of actual physical, in this case, silver, underpinning the whole market. And so in the last few weeks, well, let me back up. Early this year, with the threats of tariffs, a lot of silver and gold came into the U.S. from the London market, trying to beat the clock on the potential tariffs. Now, those tariffs are never put into place, but that put a lot of pressure on the London supply, especially for silver, which is a much smaller market than gold. Then the investment demand in the U.S., and not just the U.S., but around the world, for ETFs picked up a lot in the last few months. And most of the silver that backs the ETFs is sourced from the London market. So you had London was drained a little bit of its silver. Then the ETFs sopped up more of the silver. And then more recently, in the last month, India has had a massive explosion in demand. They've had a lot of demand for a while, but going into the festive season and so forth, and just hearing about the shortages, hearing about and seeing the price run up, gold has become much more expensive. People start switching into silver, seeing it as more affordable. All of that has put a lot of pressure on the supply coming from London because now India is desperately trying to get silver out of London. And so the free float in silver has diminished to the point where there's now bona fide, very serious shortages. And then, of course, that begets more shortages because people are like, whoa, wait a minute, I have these credits. I want to get my silver out. So now everybody's calling in to get their credits, uh, I should say, redeemed into actual silver. And so we're seeing a massive sort of dislocation happening. And it's because there's not enough silver. I mean, there's too much leverage on the silver. There's not enough silver underpinning the market. The London Bullion Market Association just came out late last week and said we can't do anything about it. There's a bona fide shortage. It's not a trading situation. There's literally not enough silver to do this, and we just have to let the price run. And so we're seeing lots of very interesting fireworks developing. We'll see how it turns out here in the next few days, the next few weeks. More than likely, we're going to see higher prices. I was personally kind of thinking we would stop at $50 for a few months, but this is not just a trading phenomenon. There's a real serious shortage developing, and then some of it is just location. So there's still a fair amount of silver in the COMEX. In fact, there's more than there was early in the year. But we're pulling metal off the COMEX ourselves right now in order to supply the mints that we're working with because demand has also picked up. So, and it was already strong in other parts of the world, but here in the U.S. in the last few weeks, it's really been picking up. So, it's a very fast-moving situation, and silver is sort of the canary in the coal mine, if you will, because it's a precious metal. It's a much smaller market. The same conditions exist in gold. It's just a much larger market. So it'll be interesting to see how it plays out in silver. That could foreshadow problems in gold at some point.
It's so interesting because, you talk about leverage. We think about going back to the banks, going back to fiat, going back to you can just create money, you can create liquidity, you can be the Fed and create QE and buy bonds and give from banks and give them money for their liquidity. But you can't do that with silver. So it seems like we're at this tipping point from everything you've described, where that demand to basically solidify contracts, investments, ETF, everything all at the same time, throw in India, throw in industrial demand and strategies that are already in place and that need silver.
Right.
And there almost is no other outcome but to have additional demand squeeze up prices in silver at this point, it seems like.
Yeah, I mean, we already have an annual deficit and shortfall in production. And, the mining industry has been completely bombed out, low prices, particularly in silver. It hasn't been economic. Silver is interesting too because it's mostly a byproduct of other mining. So the economics of a mine that produces silver is usually not driven by the silver price. It's driven by the copper price, the gold price, the zinc price. So it will take, first of all, anytime you have a shortfall in production, you're going to need much higher prices to incentivize the investment and so forth. And it takes years to bring that online. And then when you take the dynamic around silver, where most of it does not come from a primary silver mine, it's even more difficult. So much higher prices is not necessarily going to increase supply very soon or very much. And so that's why silver is so interesting. One of the reasons it moves so much is because it's a small market, but the other reasons have to do with the inelasticity of both supply and demand. So on the demand side, you have this critical metal that is used in applications increasingly that it can't easily be substituted into some other metal. So you have inelasticity around demand, you have an inelastic supply because of the mining situation and the fact it's a byproduct. And then you have, now investors coming in on top of the existing sort of baseline of industrial demand. And it just creates a very interesting scenario for silver. So we'll see. We'll see what happens.
Yeah, no, it's going to be interesting, and it's not going to. We're talking about years, really, potentially, right, of unfolding, especially on the industrial side, because you have to lock in or find a way to lock in
Right.
supply, which is limited in the future as well. You can't just shut down projects.
Yeah. And of course, when you hear about all the shortages developing, that again just signals to everyone, I better have the silver that I need. And so then they call on those obligations when they may not have otherwise done it. And you have a classic run on the bank developing. And, again, there still is a lot of silver around, but a lot of it's in weird places that are difficult to get out or get to, a lot of them stuck in but refineries. There's about 6 month backlog in refineries because there's been so much scrap recycling because of the higher prices. Some of that has been coming back, but the refineries are not able to process it because the refining capacity doesn't exist or isn't sufficient enough. And so there's all these bottlenecks and backlogs, and then of course a panic around getting your hands on the supply. And so it's just fascinating. It's a fast moving situation.
Yeah, no, it's fascinating. I hope we can continue to touch base on this going forward. And moving over to gold, obviously another fascinating for different reasons uptrend that we have seen. We've seen gold, gold sort of zoom past 4,000, hit 42, 43, sort of come back a bit. But for the most part, what's been interesting is more retail buyers coming in, more ETFs backed by physical gold expanding, but also central banks buying at these levels. And so how do you see that playing out? And also from standpoint of
That
storage, vaulting, the technology around security of gold for these central banks, how do you see that evolving?
Well, the last 3 or 4 years, really, the last 4 years, central banks have been accumulating gold at record rates. Not maybe last year wasn't quite a record, but a couple years before that, very very large amounts, and that was triggered. It had been kind of developing, but it was really accelerated around the time we did the SWIFT system lockout of the Soviet or the Russians and froze their bonds and all that. We kind of sent a message to everybody. So central banks started stockpiling gold. That in the West, they weren't buying. I mean, honestly, the last 2 or 3 years here in the U.S., gold has not been loved. It hasn't been. It's been sold. Actually, a lot of our customers at the retail level have been selling, not buying. They've been seeing the higher prices and they've been selling. So I think that we're seeing a development now of basically a sort of a global de-dollarization trade happening, and that's what's driving gold. I think it's been going on the last 3 years already, and especially in Asia and the Middle East, and Russia and so forth. But in the last 6 months or so, basically the last 9 months, most of this year, it's now come back to the West. You see the Western demand pick up. And I think everybody is now sort of evaluating how much exposure they have to the U.S. dollar versus how little they have to gold. And you had Morgan Stanley. You probably saw 2 weeks ago, 3 weeks ago. You probably reported on it that Morgan Stanley, better late than never. Of course, and many others, most other investment houses still haven't done this, but they went from their 60-40 stocks to bonds portfolio to 60-20-20 with 20% gold, 20% bonds. And that's really a switch that's happening. Central banks were already making that switch away from U.S. Treasuries to bonds, and now I'm sorry, U.S. Treasuries to gold, and now gold is the second largest reserve asset of central banks. So, now to see Wall Street sort of admitting, hey, we need to kind of look at this bond exposure that we have people, have that people have. I think it's been total negligence on their part over the last few decades. They always have poo-pooed gold. They ridiculed us as gold bugs. They won't even buy it for their clients. If they do, if the clients insist, maybe they'll let them get an ETF share. But it's really just total negligence on behalf of the financial elite, if you will, and the experts to not have their investors, their clients having some exposure to gold. I mean, it's probably 1% to 2% of U.S. investor assets are in gold in some manner. It's really a problem, and I think we're kind of asleep at the switch, and the rest of the world has already figured this out, and we're still in love with our paper, economy, our paper stock market.
Yeah, it's interesting. And as we do see more large Wall Street firms suggest that allocation, first of all, they're going to have to be participating. And second of all, that's going to mean buying or finding more physical gold. And that's
Yeah.
going to, sort of potentially balance, do you think, that the Western versus Eastern time gap that we've been seeing?
Well, we still have a lot of wealth here, and so hopefully it gets protected and by getting more exposure to gold and silver. But In the case of the incentives around financial advisors and their lack of recommending gold and silver, I think one of the main reasons, other than the anti-gold propaganda that's put out by by the elite, by the government, by the central bankers, but even just from an incentive standpoint, one thing that financial advisors know is that if they recommend that somebody buy physical gold, that is going to be socked away and it's never going to be sold again. It could be, but it usually is not. And in a world where you generate your income from turning over and churning accounts and generating fees and rebalancing and going into the client and we're going to do this, we're going to sell this, we're going to buy that. Um, Gold is no good for somebody whose business model is built around rebalancing investor portfolios. So they don't recommend it. And if they do recommend it, it's going to be in an ETF type form. And of course, in the ETF form, there's still counterparty risk. So if you're buying gold as a form of financial insurance, which is the main reason to buy it, it's a DDoL, it's a non-correlated asset to all other investments. It's really the only investment asset that does not have counterparty risk. As long as you own it and have direct control of it. So yeah, so the ETF shares has sort of a daisy chain of custodians and trusts and so forth, and so there could be issues there. Like right now, the ETFs are having trouble sourcing the metal to back the shares. So, how many of the new shares that have been issued are secured by futures contracts that haven't been delivered on yet, for example. So, again, if you're buying gold as financial insurance, then why would you put it into that scenario? Now, if you're buying it to trade, then that's fine. I mean, it's an efficient way to do that. So I think that, people are reassessing risks and reassessing how they can get themselves sort of outside of the, sort of the mainstream financial establishment, which may not have served them that well.
Yeah, no, absolutely. And on that note, and again, I know that you are incredibly busy, especially now. I thank you for joining us here today. And perhaps you can just leave some insights with investors who are watching or listening here today that either have only participated minimally in gold and silver, that are actually trusting some of their advisors who have not really put them on this path soon enough, and where they can find your information and your services so that they can basically take more control over
Yeah.
their own
Oh,
heart.
thank you. Yeah, well, go to moneymetals.com. We're one of the top 3 largest online dealers in the U.S. We also have a depository. We have the largest depository other than the New York Fed. Our depository is twice the size of Fort Knox. Our gold is actually audited, unlike the gold in Fort Knox. Although Senator Lee from Utah is introducing a bill to address that in the next few weeks, in terms of Fort Knox not being audited. But yeah, go to moneymetals.com. We buy, we sell, we store. You can even get a line of credit, like a home equity line, against your own gold if it's in our depository, or silver. And we're very prolific on the publishing side and education side. And as I mentioned, we're also involved in public policy. So if you're on our email list, you go to moneymetals.com, get on our email list, we will be able to determine, like, if we have a battle going on in your state, for example, we can alert you to that. And it's definitely the case in many of the victories that we've had at the state level, that it has been the grassroots involvement of our customers that has made the difference, by them contacting their legislator or making a phone call and helping us. So go to moneymetals.com, and we'd love to help you and work with you.
Thank you so much. And everybody, again, we will have those links here for you. You should definitely check it out, and you should definitely check out also the research that is provided by Stefan and his team, because it will help you arm yourself in this incredibly volatile time, and for the future, and for your family's future, with respect to the protection of your finances and being involved in silver and gold and other hard assets. Stefan, thank you so much for joining today. I appreciate what you've grown, and I think our viewers and listeners will get, if they haven't already checked out your information, tremendous, regular, and absolute hard value from what you provide. So thank you so much.
Thank you. It's great to be on with you, Naomi. Thank you.
And everybody, thank you so much for joining us here today at Prinsights Global Spotlight. Till next time.